Bill Baruch, president of the Blue Line Futures, to the show. Bill, can you explain it any bit better than I just say? It's the short-term rates are going up pretty much one-to-one closely with what the Fed's been doing. But then folks start to look for a return, right? And they get nervous about crashing the economy in the short term. What's that going to be in 10 years' time? So they'll start to buy those bonds, driving those rates down. Is that pretty good?
I think you nailed it. I mean, I couldn't do that any better. You nailed it perfectly there. One thing just to maybe even add a little bit is the encouragement to go farther out is sort of that uncertainty in the near term, where the Fed's driving rates higher right now. But if we go into recession, our short-term rates going to then collapse. If you are investing in a shorter-term bond, whether it's a 30-day or a 3-year, you're going to have that expiration. It's going to, you don't have to reinvest those funds sometimes soon after, and you don't know where those funds are going to, or where the rates are going to be then. This way, you can lock something in longer term and feel comfortable putting it out there. That's really one of the things that also encourages it too.
Yeah, and so I'll just put some numbers to it. Just to say that the Fed continues to raise rates, and we see the short-term rates get to say 2-year, between 3-month and 2-year gets to be around 3%, right? Well, that's pretty quick, pretty fast, and everybody's worried about what this economy is going to do today, maybe in the next 3-6 months, right? Are they going to have a soft landing? Are they going to have a hard landing? Probably more or less a hard landing. And what could that do to the economy? So I can look out, say, 10 years, and if the Fed's jacking everything up in the front end to 3%, but I can still get 2.7, 2.8% on a 10-year and have it safe and make sure I guarantee myself a 2.8% return for 10 years, some people will take that in the short term, and that'll make them feel better because of what might be happening today. You understand? Is that a good way to put it?
That's absolutely right. And here, let's just maybe shift the dynamic a little bit from the inverted yield curve. I do think we're going to flatten just a little bit. And one of the signals that I'm looking at here today is
Explain flatten real quick.
Well, we've been. I mean, at this point, we're inverted. I'm flattened, but I'm thinking we're steepened. So we're going to steepen back up, and I'm back to normalize a bit here. So that's what I sort of meant back on it. We've been flattening into inversion. So at this point, more steepened would mean the 10-year yield then outpaces the 2-year yield. So what you're going to see is the 10-year yield rise at a quicker pace. And one of the reasons why I think so right now is you have a 20-year chart in the bonds, really when bond futures were launched. And that chart right there, we broke through this 20-year trend line. In fact, on the yields, I think it goes as far back as 30 years. And we sliced through this trend line earlier this year. So when the bonds sold off sharply and yields were rising sharply, we sliced through this couple decade-long trend line, and we are now back testing that trend line overnight and today, into this morning. At a price level, it's at 146 in the 30-year bond futures. We hit it right on, and we failed out. We're actually trading a few points lower at maybe 143 right now. So we're 2% off of that level. The 10-year was at 122 in the 10-year note futures. We hit that perfectly and fell back. So technicals are still at play right here. So I think we could steepen a little bit from here. So that's something interesting. I think it's a great trade opportunity too.
Yeah. So just so everybody knows, I just want to go over it one more time. And the reason we're talking about it is it's a good indicator of recessions, right? I mean, the seven of the last 8 huge recessions since 1955. You've had an inverted yield curve. And an inversion is the Fed's ramping up short-term rates to try to cool off the economy in the short term. But everybody gets worried that they might cool it off too much and have some sort of crash or say maybe in a depression. And investors will run to something out 10 years and scoop up something that can guarantee themselves a 2.5%, 3%, 3.5% return because of so much uncertainty in the front end. That's why we're talking about it. So I don't want anybody to have that red mist come down, because I was a professor at DePaul University, and I could sometimes see the red mist come down over some students' faces. But that's really what it is. So when we talk about inversions, that means the interest rates on bonds in the short term, stuff that's not that long dated, 3 months to say 2 years, is higher than stuff that's 5 to 10 and maybe even 30 years. So that's all it is. It's nothing to be nervous about. It's just something that tells us this probably is a recession, because it's happened 7 out of the last 8 times. And I don't know if you can change the definition of a yield curve inversion. Real quick, you got about 20 seconds.
No, I mean, this is a recession. I mean, they can just say it all they want. I mean, I think just before I came on here, the Dallas Fed came out and said that it's not a recession as well. So, I mean, it's going to be a battle. I mean, we got elections coming up, and everybody's trying to, fight for every scrap they can get.
Right.